All right, let's talk about something that sounds super technical, but I promise it's actually a fascinating story about uncovering secrets. We're diving into IFRS 16. This is the rule that basically forced companies to show trillions of dollars of debt that used to be, well, hidden. Let's get right into it. So let me just kick this off with a question for you. What if I told you that for decades, and I mean decades, some of the biggest companies you can think of, airlines, giant retailers, you name it, had trillions of dollars in debt that was basically invisible on their main financial statements? Seriously, how would that change how you look at them? Well, here's the thing. It wasn't a what if, it was real. They absolutely did have that hidden debt. And the crazy part? It was totally legal. It was all thanks to this little accounting vehicle called an operating lease. And that right there was the problem that a massive new rule had to come in and fix. So you're probably wondering, how on earth was this even possible? To really get it, we've got to jump back in time a bit, to the old way of doing things, under a standard known as IAS 17. Okay, so under the old rules, the system basically split leases into two buckets. First, you had finance leases. Think of these like buying a car with a loan. The car shows up as an asset, and the loan is a liability. Makes sense, right? But then there was a second bucket, the operating lease. This was treated more like a simple monthly rental. The payments were just an expense, like your phone bill. And that meant the huge obligation to keep paying for that lease for years and years, it was nowhere on the main balance sheet. It was tucked away in the footnotes. And that, my friends, was the giant loophole. And that, of course, brings us to the big fix, IFRS 16. The people who make the rules, the standard setters, finally said, you know what, enough is enough. It's time to bring all of this into the light. And the goal was actually really simple. The official text says, the objective is to, and I'm quoting here, faithfully represent these transactions. In normal people talk, that just means no more hiding stuff. If a company owes money or has a big commitment, you, the investor, should be able to see it. Plain and simple. Now, a change this massive doesn't just happen overnight. I mean, the old way of doing things was around for more than 30 years. The new rule, IFRS 16, didn't even come out until 2016, and companies didn't have to start using it until 2019. So yeah, this was a really long, slow march towards transparency. Okay, so let's get into the nitty-gritty of the change. How does this actually work? We're going to focus on the lessee. That's just the fancy accounting term for the company that's doing the renting. You know, the one leasing the planes, the storefronts, the big office towers. So here's the absolute key takeaway. IFRS 16 pretty much got rid of the whole idea of an operating lease for the company doing the renting. Now, basically every lease has to go on the balance sheet, and they do it with a really simple two-step move. First, you add an asset for your right to use the thing you're leasing, and second, you add a liability for your promise to pay for it. Let's break that down a bit. That first part is called a right of use asset, and honestly, it's exactly what it sounds like. If you sign a 5-year lease on an office, you now have to put an asset on your books that literally represents your right to use that office for the next 5 years. Simple as that. And then on the other side of the balance sheet, you have the lease liability. This is the debt. It's the grand total of all the payments you've promised to make, all calculated in today's dollars. This is that massive number that used to be buried in the footnotes, out of sight. Now, the rulemakers weren't totally crazy. They put in a couple of common sense exceptions. You don't have to do all this paperwork for really short-term leases, 12 months or less. And you also get a pass for low-value stuff. We're talking about things like leasing a coffee machine for the office or some laptops for your team. This keeps the focus where it should be, on the big, important leases that can really affect a company's finances. All right, so that's a huge change for the lessee, the company doing the renting. But what about the other side of the deal? What about the company that actually owns the stuff and is leasing it out? That's the lessor. So did their world get totally flipped upside down too? And the answer, which is kind of surprising, is not really. Nope. For the lessor, the one who owns the asset, the rules stayed pretty much the same. And here's why. For the lessor, it's like they're still living in the old IAS 17 world. They still have to ask that classic question, does this lease basically transfer all the risks and rewards of owning this thing? If the answer is yes, it's a finance lease. If it's no, it's an operating lease. So all this revolutionary change we've been talking about, it was almost entirely aimed at just one party, the lessee. Okay, so let's put it all together. What's the real-world impact? What does this actually mean when you go to look at a company's financial report today? Here it is in a nutshell. Before IFRS 16, a huge operating lease was basically invisible on the balance sheet. After IFRS 16, bam, both assets and liabilities shoot way up because that lease is finally put on the books. For a lot of companies, especially in retail and aviation, their balance sheets just ballooned almost overnight. And this started a whole domino effect. First off, with all these new liabilities on the books, companies suddenly looked like they had way more debt. The expense itself also changed. What used to be one simple line item for rent is now split into two different things: depreciation and interest. And here's a really interesting twist. You've probably heard of the metric EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. Well, because rent expense was replaced by interest and depreciation, the EBITDA number for many companies actually went up. It's wild because nothing about their actual cash flow changed at all. So that's really the story of IFRS 16. It's about taking trillions of dollars of commitments that were hiding in the fine print and dragging them out into the open, right onto the balance sheet for everyone to see. The most important thing to remember is that the companies themselves didn't change, but our ability to see what's really going on inside them changed completely. And that leaves us with one final question to think about. Now that all these obligations are out in the open, how does it change the way you look at a company's real financial health?